I'm the Jury Saver, and in today's video, I'm going to hopefully show how we can use simulation in Excel to illustrate how long-term investing may be more useful than short-term investing. So before I go into the main video, I just want to flag, as always, that I'm not a financial advisor and this isn't financial advice. I really love maths, and this video is really just playing around with the functionality in Excel and some mathematical concepts to show hopefully how long-term investing may provide more stable returns than short-term investing. So what we're going to do, well, what I'm going to show you is the data that I'm going to be using. I'll then talk through the assumptions with the simulation. I'll go through the simulation itself, and then I'll talk through the summary results. So the data I've got on screen is I'm trying to think, from 1928 to 2023, it is the yearly returns for the S&P 500. Now, I haven't fact checked this to see if it is correct, but this is the source that I got it from. To be honest, I just wanted a set of data that we could use for the simulation, which is just for illustrative purposes. So, it's not it doesn't have to be exact. It's just to try and understand what the variability in returns could look like if you're investing in a fund. So, for example, in this one here, whether or not it's for the S&P 500, you can see that there's months where we're green, years where we're green, where we've got big gains, and then we've also got years in the red where there's a lot of big losses. So what I'm going to do, and the purpose of the simulation will be, I'm going to pretend that I've been investing in a fund in the future, and I'm going to assume that the return that I get each year is similar to the historic return we've seen in the S&P 500. So for example, if I was to invest in this imaginary fund next year, I might assume that in 1 year I could return like maybe 38%, it might be 47%. It's one of these numbers from this list. So just to go through what the assumptions are for the simulation, the first one is that I'm going to be assuming that each year's return is independent from the previous year. So if I just go back to this data, I'm just going to be randomly selecting a return from this list. So in actual fact, there's probably some economic theory that says if you've got a big swing one way, it's meant that there has to have been a big swing the other way one of the previous years. But that's too complicated for what I'm trying to illustrate in this video. So yeah, I'm not taking that into account. So I'm assuming there's some independence there. The second is that the return data that I'm using, so this list here, I'm going to be randomly sampling with replacement. And what that means is when you see the simulation, it may be that I pick out this year twice. It'll become clear when I show you the simulation, but that's just another assumption that I've used. I've also assumed that there's no behavioral change from the investor. So in actual fact, if I was personally investing over a long time period and say I had 10 years of losses, I may not continue investing for another 30 years. I might think actually I'm I'm not getting any return from this investment, so I'll put my money elsewhere. But actually, what I'm assuming here is that the the investor that we're simulating just is going to invest for the amount of period that they're setting out at the start. And then the fourth thing just to remember is that this is just a bit of fun. I'm just experimenting with Excel and the numbers to try and illustrate a point. I'm not seriously trying to make any judgments about the S&P 500 over the past 40 years or what have you. It's just to show the power of sort of mathematical techniques in terms of understanding how the stock market could perform over a set period of time. So now the exciting bit is we have the simulation. So I prepared this earlier, and I'll quickly go through how the formulas work, and then I'll show you it. But on the left hand side here, we have got the simulation run. So in a simulation, what the aim is we're trying to replicate what might happen in real life. So I have got 100,000 runs of my simulation. That it's all in this column here, and then uh, these columns are all the years. So what I'm doing is I'm pretending that I'm starting from year zero and I'm investing year on year. And then for each year, what I've done is I've randomly chosen one of these return figures from the data. So for example, this first simulation in year one, it's randomly chosen 28%, then 4%, then 1%, and then year four, it's a loss of 5%, a loss of 10%, and then it goes on up until year 40. So you can see there's a huge range of positives and minuses, and then there's a few zeros in there, and hopefully Excel doesn't crash when I scroll this, but I'll just scroll to the bottom so you can see how it goes. Is yeah, all the way to run 100,000. So I've got 100,000 simulations of this um, person's investment. What I will say, I've used the rand between function. So what I've done, I won't go into this in too much detail, but just in case you're interested in the formula, if you want to try this out yourself, I've used a VLOOKUP, I've used rand between, and that produces a random number between the limits that you set. So I've given each of these years an index, so from 1 to 96, and I've done RAM between 1 and 96, so it's produced a random number between 1 and 96, and then the VLOOKUP just searches for that index's annual return. So, and you might have spotted there as well that basically the rand between function, it recalculates every time that you kind of press like enter on a spreadsheet. So you can see it's all changed there. So one of the things with simulation is that I was only to do this 10 times, every time that random function was used and it was recalculated, if I was to take a summary of those 10 simulations, there'd be a lot of variability there. But because I've done 100,000 simulations, it means that the variability in the final results are a lot less. So that's why we simulate 100,000 times. It's to try and um, understand what the sort of long term view is without having the sort of randomness create too much variability. So hopefully that makes sense. I've got my 100,000 simulations of a 40-year investment profile, and then what I've done at the end here is the summary figure. So I've looked at what the average return is over a set investing time period. So what would the average return be over the 3 years? So say my first simulation, starting investing in year zero, after 3 years, first year was 19% investment return, second year was 3%, and third year was 13%. So that gets me an average yearly return of 12%. And actually, I'll just say, I'm going to say average yearly return over time period. And that obviously it's recalculated, so it's reset that. But you can see how that changes. So that was 6% for the first simulation, but the second simulation, actually, if it was over 3 years, it would be a gain of 22%, loss of 30%, loss of 10%. So overall, your average rate of return would be minus 6%. And then, so I've got my 3-year one, my 5-year one. So instead of investing over 3 years, I invest over 5 years. And then instead of 5 years, 10 years. Instead of then 25 years. And then finally, I've done 40 years. So an average rate of return over 40 years. And for each different simulation, we've got different summary figures. So we've got the 3-year, 5-year, 10-year, 25-year, and 40-year. And what we want to do is we want to understand in summary over my 100,000 simulations, what does the summary figure look like for each one? And I've got this in this tab. So let me break this down for you. So I've got my simulation results for 100,000 runs. I've got my investment period on the left. So we've got 3 years, 5 years, 10 all the way up to 40 years. And then over those 100,000 runs, I've taken the average. So of my what was my average return over the 100,000 runs over the 3 years, and for all of them actually, because doing it over 100,000, it sort of mitigates some of that variability. So actually, the average is 8% for all of them. But the important thing to note here, and this is where it's starting to illustrate that long-term investing um, is a lot less variable, is that um, because when you look over the kind of 3-year period, 40-year period, what have you, the swings or kind of the I'm trying to think there are a lot of instances I get over a short term where like the minimum, so the average was 8%, but the minimum over the 100,000 simulations was that there was one where the return over 3 years, the average rate of return would have been minus 44%, and the maximum was 46%. So there's a lot of variability there. Whereas if you look at 40 years, there was one instance where your average rate of return over the 40 years was minus 5%, so could have been really, really unlucky, or the maximum was 20%. So it's a lot less variable. And the thing to note here as well is that I've looked at the number of the simulations which resulted in a positive average rate of return and the number with a negative average rate of return, and then the proportion. And the more that you invest, the higher the likelihood that you're going to end up with a positive rate of return. So in this instance, for 40 years, 99% of the simulations ended up with a average yearly rate of return, which was positive, but there was only 1% where it didn't. Whereas if you invested just over 3 years, there was a 77% likelihood that you'd end up with a positive rate of return, but then it was actually 23% of instances where you wouldn't. And I think with the stock market, because no one can predict the future, you don't know at the start whether you're going to be in the 77% or whether you're in that 23%. So even investing in the long term, there's still a chance that you might be investing in a period where the stock market is really not performing well, and you could be unlucky and be one of these one of these runs might represent your return profile, and you might end up I don't know, over 40 years only returning negative 5% per year. And you can sort of see that here with the 3-year one. You might have all positives over 3 years, fantastic. But you could, and I'll scroll down and I'll probably find a one year like here, this simulation, it could be minus 12 one year, minus 13 one year, minus 11 the other year. So if you are someone who thought, actually, I'm only prepared to invest for 3 years and I'm going to stick a lot of money in the stock market, well, at the end of year 3, you've actually lost quite a bit of money. Whereas the longer you invest, the more those positive years even out the negative years, and it offsets it. And yeah, hopefully illustrating here that investing over the longer term gives you a higher chance of making returns on those investments. But yeah, I'll stop waffling there, and yeah, hopefully you've enjoyed this video. It's a bit different. You might have picked up in previous videos that I'm very numbers oriented. I absolutely love mathematics, and I love anything in Excel where you can simulate things going forward, and just some of the functionality in Excel which allows us to do this. But yeah, if you've done something similar, if there's anything that you've simulated in Excel, then do let me know in the comments below. And if you've got any other comments about this video, then just let us know, and I'll see you on the next video.